Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. It's all about Nvidia and the Japanese equities. Now, Nvidia posted its biggest one-day market capitalization boost, closing 16% higher than the previous day. Japanese equities hit the 39,000 mark, firmly closing at all-time highs. Amidst all of this, we have been seeing a risk on sentiment. Yesterday was the day of PMIs from the Eurozone, UK, and the US. Now, for the US, both manufacturing and services PMI was in the expansion zone. Good morning, JK. A lot of things to chew upon. Keen to hear your take on the markets.
Good morning, Swaraj. So, on a day of unprecedented euphoric moves in stocks across regions, everything, including economics, was a sideshow yesterday. And we do see strong, uniform rallies across markets quite often, but it's very rare that we see new all-time highs being hit simultaneously in many markets. Japanese Nikkei was the starting point, and India Nifty. Euro stocks in Europe, including DAX and CAC of Paris, and then Dow Jones and S&P 500 in the US. And at the same time, the most unpreferred Chinese market also rallied to erase all of its 2024 losses. There was no fundamental news, at least from the economy. If anything, there have been firmer indications that rate hikes in Europe and US will not happen in a hurry. The trigger, of course, as you said, came from the AI sector stock, Nvidia announcing a big beat in Q4 results and projecting 3 times leap in Q1 earnings. That was better than anticipated. And it did appear that everyone was in the party yesterday, and not being there would have been imprudent. In fact, the previous day markets had been subdued with nervousness about AI child's numbers. What happened later prompted someone to say, as Nvidia goes, so goes the world. So that was about the stock market. A unique day yesterday, of course. On to what's more, influential for our, our markets. Bonds, again, 2-year yields were higher yesterday after, repeated statements from Fed members saying there needs to be patience in cutting rates. In fact, a 2-year yield touching 4.73% was almost, at the highs that was seen just before December 13 meeting of Fed, where they actually announced their pivot. And of course, the initial trigger came from the jobless claims for the weekly number coming 12,000 less than the previous week at 201,000. Once again, confirming that the job market in US is quite resilient. Claims are hovering at historical low levels despite high profile layoffs that we saw in the starting of the year. There were more Fed voices reiterating need for patience in moving on rates. That put floor under the bond yields. The most followed person, the Mr. Weller, said cutting too soon could squander inflation progress and risk considerable harm to the economy. He also said that in the absence of major economic shock, delaying cuts by a few months should not have a substantial impact on the near term. In my view, as stocks rally, financial conditions are getting more easy, creating more wealth effect, and eventual demand push for inflation will increase. So the monetary policy will take more time to change course. Following Fed minutes on yesterday, we saw minutes from ECB and also RBA meeting as well. European Central Bank's minutes showed that the policymakers were wary of easing the monetary policy too early. In India, there were, of course, one dissent where one of the members wanted a cut in rate, saying that the time has come for MPC to send a clear signal that it takes its dual mandate of inflation and growth seriously. But I don't see too much, in water in that argument, because there is no concern about growth in India, and inflation still remains quite volatile. Other members were quite vocal in that they wanted to see more improvement in inflation since the growth itself was quite robust. So that was about the minutes. We have been seeing a series of details on the discussions that happened in various central bank meetings. PMI numbers, as you said, were announced yesterday for various regions. India continued to show rising activity levels. There was a mixed picture in Europe. Germany still lagging and other countries improving. UK showed the composite index rising to 9-month highs. US numbers showed, of course, as you said, they were in expansion territory both for manufacturing and services. But there was a contrasting picture. Services eased for the first time, and the manufacturing was showing an improvement. On the currencies, the euro did build on its recent gains and got closer to 1.09 in the European hours before profit taking set in, and also the jobless claims data from US pushing the yields up and just seeing some euro back off from its highs. However, it is building a base at 1.08 and looks quite firm. Sterling generally shadowed the euro, and of course, the yield advantage has been with the sterling because as of now, Europe and US won't cut before June. If anything, it may be pushed even further. In UK, the current expectation is no rate cut before August. So that is the situation as far as the monetary policy is concerned. Currencies are generally following what's happening on the monetary policy indications. Yen stopped falling, wanting to see more reactions from the Japanese officials, and also a market holiday in Friday. That could have kept the currency market a bit on the sidelines. Recovery in stocks has not helped any appreciable rally in yuan so far. That means foreigners are still selling the Chinese assets. Now, for once, rupee was also following the moves in the broader dollar yesterday, gaining towards 80 to 80 in a slow move. Once again, heavy flows rumored, but with buying from importers keeping the momentum low. The fresh upbeat sentiment in risk assets across major markets and big recovery in Indian markets from their sell-off on the previous day also helped the rupee. Now, the thing about rupee is it has supports at and resistance at every 10 paisa, and hence the moves on either side tend to be very slow, and they can only gain momentum if we do see important levels at 82.70 on the lower side and 83.30 on the upper side. So that rupee don't expect a dramatic moves as yet. Just as a additional information, the global debt has hit a record high of 313 trillion. That's as per the International Institute of Finance. And developing economies have scaled a fresh peak in the ratio of debt to GDP. GDP. So that's about a small information. Thank you.
Thank you, JK. And it seems the Friday party was started early, especially seeing the euphoric moves in equities. And now strong uniform rallies and all-time highs being hit simultaneously for DAX, S&P 500, Dow Jones, India's Nifty, and of course the Japanese markets. So very interesting set of moves in the equity markets. When it comes to US and the rate watchers, jobless claims showed labor market resilience. Now, Fed voices reiterated patience to cut rates, and truly so. In the absence of any major economic downturn, a bit of waiting before cutting rates should not hurt. When it comes to PMI numbers, Indian PMI was strong in Europe. Germany continued to lag in US. Both the services and manufacturing were in expansion, but the pace of services definitely slowed down. Now, euro has been building up on its gains, basing around 1.08. And when it comes to the rate cut expectations, both US and Europe are not expected to cut before June, while for UK it is expected only in August. And for rupee, of course, the support remains at every 10 paise lower. 80 to 70 is an important level. And as of now, no dramatic move is expected. That's it from us today. Have a very good weekend. Tune in on Monday for the latest in the financial markets.